Singapore banks are the talk of town lately, especially after their stellar stock performance. With dividend yields of 5 to 6%, they seem like an incredibly attractive play for dividend investors. But before you rush to hit the buy button, let's take a step back. In this video, I'll break down why I'm staying on the sidelines, at least for now. Singapore banks have been on fire lately. High interest rates and a booming wealth management business have driven their assets and fee income to record levels. Demand for loans is also set to improve with the US Federal Reserve easing interest rates and China rolling out stronger than expected monetary stimulus measures. ASEAN economies stand to benefit from rising global commodity prices as the US dollar weakens. So yes, banks are reaping the rewards of these macro tailwinds. But here's the catch. Bank stocks are cyclical investments, closely tied to the economy's performance. Right now, things look great. Loans are performing, profits are soaring, and dividend yields are tempting. But remember, cycles don't last forever. After a 30% rally this year, the big question is, how much upside is left? Could stock prices go higher? Sure, but what happens when the regional economy weakens? Things can unravel quickly, and that's the risk I'm concerned about. Bank dividends are also not guaranteed. In 2020, MAS capped dividend payouts to just 60% due to the uncertainty brought on by the pandemic. While that restriction has been lifted, there's no guarantee it won't return during another financial crisis. And when banks cut dividends, it often triggers a double whammy: lower payouts and falling share prices. Ouch. Historically, bank stocks have offered better returns after some sort of financial crisis. Bad debts are written off, expectations reset, and opportunities emerge. Now, I'm not saying that no one should invest in banks right now. Every investment decision comes down to your own personal risk tolerance and financial goals. So, some of you might be comfortable taking on higher risk for potentially greater returns, and that is perfectly fine. Why banks after a crash? As retail investors, we don't usually have access to the thousands of small businesses that drive the economy, your favorite cafes, salons, and local shops, but banks do. By owning bank shares, you are indirectly investing in the broader economy. When the economy recovers, banks often deliver excellent returns. Of course, this doesn't mean that all banks are good investments, but it will be good to learn how to identify those that will survive and recover after a slump. If you enjoyed this breakdown, don't forget to like and subscribe. As always, I'm leaving the link to my write-up in the description box below. See you next time.